We are taught to believe that financial crimes happen in the shadows. Briefcases of cash, offshore islands, or coded phone calls between gangsters. But the truth is much darker. The real crimes happen in daylight, inside skyscrapers made of glass and steel. Behind the polished facades of the world's largest financial institutions lies a system designed not to stop dirty money, but to hide it in plain sight. Our investigation began with a single number: over $10 billion in fines. 0 executives jailed. That number belongs to one of the world's most powerful banks, a household name trusted by millions. Yet beneath that trust lies the hidden engine of the dark economy. This is not a story about one rogue trader or one shady deal. It's about a global network that allowed dictators, drug lords, and even terrorist financiers to move money safely into the Western banking system, with the government's full knowledge. What you're about to hear isn't speculation. It's based on leaked internal reports, official government investigations, and interviews with whistleblowers who risked everything to tell the truth. We call this story the Secret Network. The bank at its center became so large, so essential, that shutting it down was considered too dangerous for the global economy. But in protecting the system, regulators also protected crime itself. The first mechanism we uncovered is the corrupted heart of international finance, the correspondent banking network. On paper, it's simple. Smaller banks around the world need access to the US financial system to clear transactions in dollars. To do that, they open correspondent accounts at big American or European banks. Those large banks act as gatekeepers to the global economy. But what happens when the gatekeeper stops guarding the gate? This single bank built the largest correspondent network in history, over 3,000 smaller banks connected directly into its system. Many of those banks were in high-risk jurisdictions known for drug trafficking, sanctions violations, or corruption. The result was a digital pipeline capable of moving billions across borders with almost no oversight. From 2008 to 2012, internal compliance teams repeatedly flagged suspicious transfers coming from Mexico, Lebanon, and the Middle East. They noticed that hundreds of millions were moving through accounts tied to cartels and sanctioned regimes. Compliance officers sent urgent reports to senior management, begging them to freeze the transfers. Instead, they were told to stand down. The reason? Each of those transactions carried wire fees. The more money that moved, the more profit the bank made. One whistleblower described the culture as, "Don't look, don't ask." The compliance department existed to provide cover, not control. The number of flagged transactions became so overwhelming that staff simply stopped reviewing them. Between 2006 and 2009, the bank processed more than $60 billion in wire transfers from Mexican branches alone, much of it later linked to drug trafficking proceeds. The money flowed freely, disguised by the complexity of global finance. But the deeper truth was that the system was designed to be opaque. Correspondent banking operates on trust. One institution relies on another's due diligence. When one bank fails, the risk spreads invisibly across the entire network. And this bank turned that flaw into a business model. A case from 2010 tells the story. A small bank in Latin America, already under investigation for laundering cartel money, was still allowed to use its correspondent account. Hundreds of transfers were routed through to New York. Each one was approved, logged, and quietly forgotten. By the time regulators noticed, over $100 million had already been washed clean, and the bank collected its fees on every single dollar. Another case, involving a sanctioned regime in the Middle East, showed how easy it was to bypass restrictions. Officials there used shell intermediaries to disguise oil revenue as humanitarian trade. The funds traveled through the same correspondent network, through Switzerland and straight into the US market. Internal emails later revealed that senior executives were warned of the violations and deliberately chose not to act, fearing the loss of an entire client region. The magnitude of this system is staggering. Millions of transactions per day, billions of dollars per week. Each one a drop in a sea of money too vast for regulators to meaningfully police. But correspondent banking was only the first layer. The second was more deliberate, more cynical, and more profitable. The firewall that was supposed to stop financial crime is something called Know Your Customer. Every bank is required to identify who its clients really are, verify their source of funds, and assess their risk. But inside this bank, those rules were rewritten. Our investigation uncovered internal training documents from the bank's Latin American division. They instructed employees on how to simplify profiles for politically connected clients. In one memo, compliance staff were told to classify high-risk individuals as standard clients to speed up account openings. The memo even provided sample language: client involved in trade and logistics. The reality? The client was a known intermediary for a drug cartel. In Switzerland, another branch developed what insiders called client cloning. When an account was flagged as suspicious, staff would open a duplicate under a slightly different corporate name, allowing the same money to continue flowing. The documentation would show that the first account was closed for compliance reasons, a perfect illusion of oversight. A Senate investigation in 2012 confirmed the scale of this failure. The report detailed how compliance teams inside the bank's Mexican branch repeatedly tried to shut down accounts linked to cartels. Management overruled them, citing commercial importance. The phrase became a code word: profitability above the law. Employees were rewarded for risk-taking. The higher the deposit volume, the higher the bonuses. Some branches even introduced client referral fees, where bankers earned commissions for bringing in new high-net-worth customers, no questions asked. The internal culture didn't just tolerate criminal money, it encouraged it. The irony is painful. The very system meant to prevent laundering became the tool that made it easier. Every time a compliance officer raised a red flag, it was buried under an avalanche of internal bureaucracy. But the real transformation, the point where the bank stopped being a gatekeeper and became an architect, came with the third technique, the offshore shell corporation blueprint. This is where the cleaning happens. To understand it, imagine a single bribe, $50 million paid to a corrupt European official in exchange for a government contract. The money can't go directly into a personal account, it would be flagged immediately. So the official hires a lawyer, who sets up a shell company in the Cayman Islands. That company has no office, no staff, no product. It exists only on paper. The shell then opens an account at the bank's Caribbean branch. The official is not listed as the owner, the lawyer is. A few months later, the company receives loan payments from another offshore entity, actually just the bribe money disguised as debt repayment. Those funds are transferred through the correspondent network, ultimately landing in a private account in Switzerland. Now comes the final stage, transformation. The money is used to purchase luxury real estate in London. The property title lists the Cayman company as the owner. Legally, the official owns nothing. Practically, he owns everything. This process was not rare. It was routine. The bank didn't just accept these clients, it advised them. Internal documents obtained by investigators show that relationship managers provided clients with structuring guides, step-by-step instructions on how to move funds discreetly. The bank became a global concierge for hidden wealth. By the time regulators pieced it together, the scale was beyond imagination. Between 2000 and 2010, the bank processed an estimated $1.3 trillion in suspicious transactions. Trillion with a T. It was one of the largest money laundering operations in modern history. And not a single executive went to prison. This is the moment where our first mid-roll break fits, because what comes next exposes not just a bank, but a system built to protect it. After the investigations, the bank admitted wrongdoing and paid a record fine of $1.9 billion. At first glance, that seems enormous. But in the same year, the bank earned $25 billion in profit. The fine represented less than 1 month of revenue. For the executives, it wasn't punishment, it was a business expense. The cost of doing business in the world of dark money. And yet the question remains, why wasn't anyone jailed? The answer lies in 3 words that define modern capitalism: too big to fail. Regulators quietly admitted that prosecuting the bank could destabilize the entire financial system. So instead of dismantling it, they settled. The message was clear. If your crimes are large enough, the system protects you. But the deeper truth is even more disturbing. Documents from inside the US Treasury show that government officials debated whether shutting down the bank would jeopardize national economic interests. Translation: the bank was so intertwined with global finance that its collapse could trigger another crisis. So they let it live. A confidential memo from one prosecutor described the decision bluntly: collateral consequences outweigh accountability. In plain language, justice was traded for stability. This wasn't an isolated event. Over the next decade, the same pattern repeated with other major institutions. Fines, apologies, compliance promises, but never arrests. Executives retired rich, shareholders shrugged, and the system moved on. What the public didn't know was that the settlement didn't end the practice. It institutionalized it. Once the precedent was set, banks realized they could launder money, get caught, pay a fine, and continue business as usual. Financial crime became predictable and profitable. The victims, as always, were ordinary people. Drug trafficking, fueled by laundered cash, destroyed communities. Corruption drained public budgets. Terrorist networks used the same channels to fund violence. Every transaction had real-world consequences, but the people responsible sat behind glass offices, immune to the chaos they financed. In the years following the scandal, new leaks began to surface: the Panama Papers, the Paradise Papers, the FinCEN files. Each one pulled back another layer of the same story: banks, law firms, and corporations colluding to hide trillions. And at the center of those networks, the same familiar names. Governments promised reform. They pledged transparency, stronger compliance, more oversight. But the reality is different. Global finance runs on complexity, and complexity protects the powerful. Every new regulation spawns a new loophole. Every new watchdog is underfunded or undermined. Today, that same bank continues to operate in over 60 countries. it remains one of the most profitable institutions on Earth. Its advertisements still promise integrity, transparency, and trust. But behind those slogans lies the truth of a system that launders not just money, but morality itself. The story of this bank is the story of modern capitalism, a machine so large that it eats its own ethics. We believe sunlight is the most powerful disinfectant. Exposing these systems matters, because every time a whistleblower speaks, every time a document leaks, the illusion cracks a little more. The system won't change from within. It changes when people like you demand it. When viewers turn awareness into action. When pressure forces power to answer. If this investigation opened your eyes, don't let it end here. Subscribe to our channel, share this story, and check the links below for tools that help you protect your data, your privacy, and your future. Because the money isn't just dark, it's hidden in plain sight. And we're here to uncover it.